Good morning. My name is Jacob Dreyer. I'm with the Congressional Budget Office. This is a consecutive program in the series of discussions on major economic problems facing the United States. The series is being sponsored by the National Economists Club Educational Foundation in Washington, D.C. And today's program is being co-sponsored by the George Washington University, also in Washington, D.C. Past discussions in this series focused on many topics of crucial importance, such, for example, as the slowdown in productivity, the federal budget deficit, or the conduct of monetary policy. The topic of today's discussion is United States in the world economy. Needless to say, this topic is at the center of attention of the nation's policymaker, business leaders, the media, academic experts, and the public opinion at large. Today's panelists, universally recognized experts in the field, are uniquely qualified to address the issue at hand. Dr. Gary Hufbauer, on my right, is professor at Georgetown University, and Dr. Henry Now is professor at George Washington University. Both have to their credit numerous publications, books, monographs, articles exploring various aspects of the American presence and role in the world economy. Both also dealt with international economic problems and important policy-making capacities in the executive branch of the federal government. We'll let them pursue what promises to be a lively exchange for some 35 minutes. The remaining 20 minutes will be set aside for questions from the audience. I would like to start by referring to some of the charts both of you have in front of you. What those charts show is what we all know, is that our imports as a share of domestic demand keep growing, while our exports, both as a share of our total output and as a share of world total exports, keeps plunging. The record trade deficits and growing external indebtedness are a reflection of these trends. My question is to you, Gary, what are the fundamental causes of our decline as the dominant economic power in the world? And is this decline, in your opinion, irreversible?
Well, the decline shown in these charts is really an increase in our current account deficit, often referred to as the trade deficit. And I would say there are 3 or 4 major factors behind that. The first and foremost one is that we're not a very thrifty nation. We're certainly not thrifty at a personal level, despite a very heavy emphasis on incentives for personal savings. The personal savings rate has plunged. Nor, of course, at the government level. We have a massive federal government deficit. Secondly, we have shown a lack of vigor in bringing new products to the market in recent years, and at the same time, Japan and Europe have shown somewhat more vigor in that dimension, and that's hurting us. Thirdly, we've been in a world environment in the last 5 years which has been, I think, an environment where depression threatens. And if the United States had not provided an engine of growth in the world economy, depression would have occurred. So in a sense, what we often see as weakness, namely this trade deficit, has been a way, and a very effective way, of keeping up the world economy. Now, does that all translate into a long-term decline in the United States? Are we over the hill? Are we going to once again reassert our position? I would suggest that the first 2 factors are worrying, namely a lack of thrift in this country, taking all major sectors, and a lack of innovation. But the fact that we've helped stimulate the world economy is a virtue, not a vice.
What is your opinion on this subject?
Well, I agree with the 2 points, at least, that Gary has made. There's no question about the fact that the U.S. Economy is premised and has been for most of the post-war period on a much lower savings rate than those of some of our trading partners in the world economy. And it is also true that the willingness on the part of the United States to run a very large current account and trade deficit over the last several years has in fact been the principal factor helping the world economy along in this recovery phase. I would, however, sort of look at the problem in somewhat longer term perspective and perhaps not be quite as concerned about the ability of the United States to compete in the world market, especially in terms of bringing new products to the market and being competitive across the board. Gary's third point. I mean, first of all, one has to, I think, recognize that it was inevitable that we would lose some of our competitive dominance in the world economy over the last 2 decades. We now have very, very vigorous competitors. To some extent, we contributed greatly in the post-war period to their emergence. They are strong democracies. They are part of the Western community. I don't think we should be necessarily upset by that. In fact, it should help us to become, it should help us to compete more vigorously ourselves. Secondly, it seems to me we are, in the United States, shifting first. There's a big, large structural shift going on in the U.S. economy from the manufacturing sector into the service sector. We're on the leading edge of that, I think, certainly in comparison to Europe and perhaps also in comparison to Japan. Inevitably, that has had an effect on our foreign trade balance because services are not as extensively traded, at least at this point. And therefore, I think that's a long-term structural factor that accounts for some of the deficit. Finally, the third factor that I would point to is a period of transition that we have been going through, it seems to me, over the course of the last 5 or 6 years. To some extent, the U.S. economy has been leading the world economy, I think, towards levels of low inflation, revived market incentives through tax reform, and in that process, inevitably, the United States has been having an effect. Its policies here at home, in part policies that we've not been able to pull off completely, such as the attempt to lower the role of the government in the domestic economy. We did that on the tax side, but we failed to do it on the expenditure side. The resulting policies then of the high dollar and high interest rate in effect transmitted some of these transitions going on in our economy to the rest of the world, certainly helped to bring down inflation throughout the OECD countries. Now that process has been accomplished, it seems to me, for the last couple of years. I've been certainly advocating very strongly that we get the deficit under control, the budget deficit, which underlies the trade deficit. But I think there has been some transition that we have been going through over the last several years, which also accounts for the, in terms of lowering inflation, reviving markets, which accounts also then for some of the deficit, trade deficit that the United States has run.
I would like to echo what you said about the policy initiatives in recent years and pursue this topic a bit further. The question essentially arises on whether is the record trade deficit primarily an inevitable consequence of policies or policy mistakes, or the U.S. dismal export performance of the last decade has its roots elsewhere. Given, for example, such disparate factors as the industrial or economic structure of the United States, cultural mores as reflected in low savings habits, the demographic pattern, or perhaps factors originating abroad, such as globalization of the world economy. Isn't it possible that the eclipse of the United States as the world's foremost trader was preordained, no matter what policies were or would have been pursued?
Well, I think if you take a very long view, let's say a 20-year view, then the U.S. was bound to drop in relative terms as a supplier of exports to world markets, and in relative terms as a producer of gross national product compared to Europe and Japan. But what is remarkable about the last, say, 6 years is how rapid this decline has been, and at a much faster pace in terms of the current account deficit and the trade deficit than, and the export position than one would see looking at long-term trends. And therefore, I see the last 6 years as being a direct result of, you could say, short-term macroeconomic policy. And in a way, it was a happy coincidence, because we had a macroeconomic policy which had as its first target in the early 1980s trouncing inflation. And if that had been the end of macroeconomic policy, my firm belief is we would have a recession comparable to the 1930s recession at this time. That would have been a true disaster, and the sort of debt crises we see in Latin America and elsewhere would have long ago been turned into outright debt moratorium. And we would have had not 13% unemployment in some parts of Europe, but 18, 19, and we would not be enjoying a 6% unemployment rate here in the United States today if we had not had a companion policy. And that companion policy was a super stimulating, a super Keynesian budget policy. And I don't think it was planned out. I think it was an accidental result of tax cuts which were supposed to generate a lot of revenue and didn't, and maybe it was fortunate they did not. Well, all of that then spilled over into the international economy and produced this very rapid drop in net exports, which was a combination of imports continuing to rise and exports just not doing very well at all. Now, beyond that short-term event, there is this longer, I would say, weakness of the United States in serving world export markets. And it's one should, I think, make this following important distinction. U.S. corporations on a worldwide basis are doing quite well. Their percentage of world export markets is held approximately constant at about 17 or 18% for the last 25 years. But exports from the geographic territory of the United States have been on a consistent decline, and one of these charts shows it very well. It's just as a percent of world exports, we're dropping. And I think that says a great deal about the kinds of products that we're making in this country, the kinds of productivity we bring to the making of those products and our marketing, all of which is woefully inadequate.
Yes, Henry, I would like your opinion on the subject of whether or not a different set of policies could have produced a meaningfully different result by early 1987.
The policies that were pursued in the early 1980s, it seems to me, have contributed substantially to the size of the trade deficit. At the same time, however, they've also, it seems to me, contributed to some improvement in the overall U.S. economy, and let me explain. The original efforts of the Reagan administration was, of course, to try to bring about three basic objectives: to lower the rate of inflation, to revive investment incentives in the economy, and hopefully to expand and continue to build openings in world trade markets around the world. Now, the way they were going to do that was by, of course, tightening up discipline on the money supply, lowering the role of government in the economy, both by reducing taxes and expenditures, as well as by reducing the level of regulation in the economy. Now, the policies didn't work out exactly the way they saw it. They were able to reduce taxes, but they were unable to reduce expenditures. They made considerable progress on deregulating, and of course, in at least the early months, the early quarters of the Reagan administration, the Federal Reserve significantly tightened up on money supply. Now, the resulting budget deficit, which also contributed to the high interest rates and ultimately to the high dollar, seems to me had beneficial consequences, even though it wasn't planned. It had beneficial consequences on two fronts. It had disastrous consequences on the third front. That is, it helped us to lower inflation much more rapidly than we would have been able otherwise to lower it. Secondly, it also helped us, I think, to revive markets. The first 8 quarters of this recovery show a much larger contribution of investment to growth than in any of the previous recoveries in the post-war period. There was substantial investment in the first 8 quarters of the first 2 years of this recovery, and that, I think, is showing up now in the manufacturing sector in the U.S. economy, where productivity has been growing at a substantial rate over the last 5 years, 3.8% a year. In fact, during the period from 1981 to 1986. These are numbers that you don't frequently hear, but they are solid numbers, which suggest that, in fact, a good deal has been going on, good deal of investment, cost-cutting has been going on in American industry, in part under the tremendous pressure of imports brought about by the high dollar. Now, where, of course, the policies had a disastrous effect, I think, was in the trading area. They put our import-competing industries under enormous pressure. They made it almost impossible for our export industries to compete abroad. And it's one of the reasons, of course, why we have got to ultimately deal with the underlying problem of the budget deficit in order to bring about some improvement in our trade situation to enable, once again, the export economy to expand, as it has always done long before this point in a recovery in comparison to previous recoveries. So I would be much less pessimistic, I think, about the capacity of American industry if we can, in fact, now correct the budget deficit over the next couple of years. If we get some improvement in the trade deficit, as I think we will this year from the correction of the exchange rate, and if we don't have to continue to pump up the money supply, which is, of course, one of the ways in which I think we have been able to get some of the improvement in the exchange rate over the course of the last 18 months. I would be much more optimistic that we're in a position to compete effectively in export markets.
In front of you there is another interesting chart. This is a projection by my institution, the Congressional Budget Office, of the U.S. net external indebtedness. And this projection, uncertain as it is made under the assumption which you stipulate, reduction in the federal deficit as implied by the Graham-Rudman-Hollings targets, and an improvement in the trade deficit, which has already started. Nonetheless, because there is a friction and lags in the system, the net foreign indebtedness, as you can see, will exceed in early 1990s $1 trillion. What do you think, Henry, would be the consequences of such a rapid buildup of foreign debt for future living standards of American residents?
Well, the simple economic consequence will be a requirement on the part of the U.S. economy to shift resources out of domestic production and consumption into exports, which means that, relatively speaking, Americans will have less opportunity to consume, certainly at the levels at which they have been consuming over the past several years. The question really is whether or not we are, in the present period, when we are, in fact, accumulating this debt, or when we're pursuing these policies that lead to this rising debt, whether we are, in fact, investing some of these borrowed resources in such a way that we will be in a position to export aggressively and competitively in the future, and therefore be able to service those debts. Now, as I indicated before, I believe in the first 2 years of this recovery, we were doing very well on the investment front. In the last 2 years of the recovery, that is 85 and 86, we've been doing much less well. And our investment rates have gone down. They were perhaps even negative last year as a result of a lot of concern and uncertainty in industry about the tax reform legislation. But it's quite clear to me that we've got to get our levels of investment back up. I worry more about them than I do our levels of savings, because as long as we're borrowing money abroad to invest sensibly in the strengthening of American industry, which will then enable us to service those debts in the future, I don't worry that much about this large external deficit. But if we are using those borrowed resources to consume, and we are not, in fact, creating the productive capacity to handle those debt servicing obligations, then, of course, I'm very worried.
Well, Gary, I would like to know, because what Henry said, and everybody will agree with him, that the wedge has got to be created as between the output and the absorption. The absorption has got to go down relative to output. The question is, will the output go up or the absorption go down?
Very well put, Jacob. Well, let me start with that question and make some further comments on this most interesting chart. I think we're going to see a terrific export boom in this country, despite my earlier pessimism. I think it will be driven by lower exchange rates, and I'll come to that in a moment. So I come down on the side that output will go up very substantially. And I think to a certain extent the stock market in recent months has been anticipating much larger output by the Fortune 500, where of course exports are concentrated. Exports are highly concentrated in the largest 100 corporations in this country, and I see that the inevitable result of this kind of chart of debt, which will have to be corrected at some time, now who knows when, but at some time will have to be corrected, is a terrific growth in net exports. And so I'm fairly optimistic about that side of the story. Let me make a few more comments about this chart. Firstly, it shows the debt load, or sorry, the external investment position of the United States, external claims on the United States growing to, as you said, about $1 trillion in the early 1990s. And of course, as an absolute number, that is staggering. But I don't think absolute numbers are the appropriate way to look at these magnitudes. The appropriate way is as a percent of GNP. And in the early 1990s, that would be about 20% of GNP. I don't know what the appropriate upper limit is, either from the standpoint of foreign holders of claims against the United States or from the standpoint of the United States political tolerance for foreign holding of claims against the United States. But let me suggest that 20% is not an exceptionally high number by the standards of other OECD countries. There are several OECD countries which have seen numbers of that magnitude and some which have seen numbers of much higher magnitudes, 50, 60, 70%. The United States, of course, is much larger than those other countries, and so how far can we go? Who knows? But 20% level doesn't trouble me as much as the fact that the diagram just keeps on going down. I mean, there has to be some turnaround point. And will we get a turnaround at a 20% debt load, at 15%, at 25%? That's a very complicated question. I certainly don't have the answer to it. But I would suggest that this diagram portends a further drop in the exchange rate of the dollar. Now, I understand, Jacob, from what you said before our session, that already built in is a 4% annual decline in the trade-weighted value of the dollar in this diagram, and still we get up to a $1 trillion deficit, and still, more importantly than the $1 trillion, is that the number is getting larger. That is, the net external claims on the United States are getting larger and larger. Well, that says to me that we're going to see a very substantially higher rate of drop in the exchange rate of the United States. Policy ought to anticipate that and not fight it, and maybe we'll come to that later on in this discussion.
Very well. In the meantime, I would like to touch upon two aspects of growing foreign indebtedness. The one question that I would like to ask, perhaps I'll start with you, Gary, this time, is the implied growing debt service on this accumulated debt. Does it bother you at all that the growing share of output produced in the United States will be accruing to foreigners in the form of dividends and interest? That's to say, the income to capital will increasingly go to foreigners, whereas income to labor will increasingly go to U.S. residents.
It doesn't bother me, but I've never been much of a Marxist, and the way you pose the question is a slight Marxian overtone to it. That is, the foreigners become the capitalists, and the U.S. citizens become the proletarians in this new world economy. That's good fodder for congressional debate in the future, no doubt. That will be a big issue. But I'd say come back and look at the numbers, even at the end of your chart. 20% of GNP would be net external claims by foreigners. Let's suppose they earn 10% on their 20%. Well, that comes down to then 2% of GNP is the servicing burden abroad each year, and I don't regard that as a horrific burden. In fact, I regard this net external claims held by foreigners as in a way, a strength. I don't want to overestimate this, but it would be a strength in the following way for the U.S. economy in the early 1990s. There will be a lot of foreigners who hold claims in this country. They will be very willing to be cooperative with our policies to ensure that their claims are repaid in real money and not inflated money. Many of these foreigners will think about not putting so much money into bonds and putting more money into direct investment. Some of these foreigners will think about moving to the United States. I think all of those are positive developments of what is commonly regarded as a very negative or gloomy forecast.
Do you agree, Henry, with this total lack of xenophobia on Gary's part?
I agree with Gary that the economics are all on the side of this level, certainly, of foreign investment in the American economy, at least as we project this out. But clearly the politics may judge otherwise, especially, it seems to me, if there is a significant further decline in the exchange rate of the dollar, as Gary tends to believe may occur. If that's the case, I foresee a political problem in the next year or two with the levels of foreign investment, especially direct foreign investment in this country. And I can very easily foresee some congressmen beginning to argue that by having cheapened the dollar the way the administration has, or the way the country has, that we have turned America into sort of a low-cost bazaar for foreign investment. That is, to buy out at a very, very inexpensively, very cheaply, buy out American assets and essentially turn the United States into a largely foreign-owned, if not foreign-occupied, economic system. I hope that doesn't happen, because I think we have a great deal to gain from higher levels of foreign investment in this economy. Traditionally, we've absorbed products and somewhat less compared to other economies, at least, the presence of foreign investment and foreign business. And I think we're gaining a great deal from the influx, for example, of Japanese foreign investment into this economy, the management, the technology, the quality control. Many of these capabilities which the Japanese excel in and which could indeed help us to improve, it seems to me, our innovative capacities, especially our capacity to bring products in high volume to the market and support this export boom that we will need over the course of the next decade. So I would hope that somehow we anticipate the potential political reactions to this process and manage to hold those political objections under control, so that we can in fact benefit from the economic aspects.
Oh, well, in this case, let me touch upon another aspect of growing net indebtedness of the United States. It seems to me that one source of our diplomatic and strategic primacy in decades past was our status as the largest world's creditor. What do you think are the foreign policy, that is, strategic and diplomatic implications, if there are any in your judgment, of the U.S. accession to the exalted status of the world's largest debtor?
Well, it is true. I suppose if you were to look historically, you would find that almost all great powers in the international system, at least at some point in their reign, so to speak, were also important financial powers, if not the dominant financial powers in the international economy at that time. So one wonders what a weakening of the American financial position might mean over time for America's larger strategic and foreign policy interests in the world. I don't foresee our financial position weakening very quickly, or indeed over time, probably at least over the foreseeable period, next 25 years. I don't even see it declining very much. The reason has to do, I think, with the fact that both of our financial competitors, in this sense Germany and Japan, are not as able as as countries have been traditionally to convert their financial power into full-scale strategic and foreign policy influence. in the international system. They are still extremely limited in their strategic and foreign policy activities, and will continue to be so, and therefore I don't foresee a challenge from our major financial competitors across the board in the foreign policy and strategic areas, and therefore I don't really anticipate, nor am I terribly worried at this point about America losing its capacity to influence the larger issues in international affairs, the strategic and security issues, as it encounters stronger financial competitors, and even as the German mark and the Japanese yen become more important in the international system as perhaps alternative currencies to the U.S. dollar. So I don't think that these financial trends portend any significant consequences for America's strategic and foreign policy position, at least when I consider it in those terms.
And I'd like to tread on Henry's area of expertise, which is security and strategic policy, and voice my own concern on this, which I've always regarded as the worst aspect of this picture which you portray at the Congressional Budget Office, namely very rapidly rising external claims of the United States. It seems to me that there's a good chance that that picture will be translated into a reinforcement for the call to let Europeans provide for European defense and to bring American troops home. We had an initiative many years ago under Senator Mansfield. Now we have Senator Nunn suggesting the same idea, and I can see these numbers feeding into that in a very strong way. Bring 100,000 troops home. In economic terms, bringing 100,000 troops home or any other such number will not make much difference to this picture. But the conjunction of forces and the presentation that look at America as having difficulties, is not growing as rapidly, America is building up these huge external claims, why don't the Europeans provide for more of the defense? And why not the Japanese? Well, I can see that conjunction of forces unraveling what has been overall a rather satisfactory arrangement of strategic power and defense relations in the post-war world, or accelerating a process which on other grounds is already in motion.
Henry, do you wish to answer?
Well, I think, no, I wouldn't disagree with Gary. I think those are factors that in the short run will complicate the debate about security policy both in Asia and in Europe. But I think the factor that has always applied in these circumstances, at least up till now, and I think for the foreseeable future, is that Europe and Japan really don't have alternatives at this point. And under those circumstances, they are likely to make the adjustments, whatever adjustments are needed, in order for the American presence to remain and in order to deal with political objections in this country. Although I by no means would want to underestimate the degree of continued leadership it will require on the part of American politicians and American leaders to convince both the American people as well as the Congress that our interests are at stake in the rest of the world. We've learned that painfully in the course of this century, and we will simply have to bargain, it seems to me, harder with the Europeans and the Japanese, and ultimately they will make the adjustments necessary in order for us to continue to persuade Congress to finance and support our deployments around the world.
Very well. Let me try to shift the focus of our debate from the strategic implications of growing indebtedness to international coordination of policies. As we all know, recent attempts by the United States to engage in a cooperative management of the world economy with other major industrial powers resulted in a temporary agreements or understanding on exchange rates and also on macroeconomic policy postures in different countries. At the same time, however, we witnessed episodes of dissent and friction and discord among allies when their interests did not coincide. Do, in your judgment, Gary, attempts to coordinate policies make more good than harm, and is such formalized coordination simply inevitable in today's highly interdependent world?
I see some room for cooperative management, but I'm not terribly optimistic about it. And let me spell out briefly why. Where we really need cooperative management amongst the OECD countries, and more particularly between the U.S., Germany, and Japan, is on fiscal policy, and more specifically fiscal deficits. And that's virtually impossible for the simple reason that fiscal policy is almost out of the control of the executive branch in this country and not very much in the control of the prime ministers of our principal allies. Fiscal policy is just very much the product of a whole lot of pressures in any society, and it's not centrally controlled very ably. That's where we need cooperation, and we can't get it at an international level if you don't have centralized control at a national level. What does that leave? Well, that leaves some cooperation possible on monetary policy, respective rates of monetary growth. And perhaps there's some use that can come out of that, and I don't want to be too negative on that. Now, there's another dimension which some people will say is just a shadow of monetary policy, and that's exchange rate policy. And that's where the discussion has really focused in recent times, well, since the Plaza Hotel Accord of September 1985, on exchange rate policy. And there has been a great deal of friction and discord in recent months on that. My concern with the recent Baker agreement at Paris with his 6 colleagues from the summit countries is that perhaps the U.S. too quickly entered into an accord on exchange rates. I mean, if we believe any of these numbers, there's no way we can hold the exchange rate at present levels, which is what we essentially subscribe to do, plus or minus a little bit, with Japan and Germany. And we gave up maybe the one lever we had in exchange for what? There's no agreement on fiscal policy, and it's not clear to me there's any agreement on monetary stimulation in Europe or Japan either. So I endorse the notion of cooperation, but I don't hold out a great deal for it, and I'm not sure the cards were rightly played this time around.
What about you, Henry? Since you wrote profusely on the subject, you must have something to say in the matter.
Usually when I talk about this subject, I'm accused of not being in favor of cooperation, which is not the case at all. However, I do believe that sometimes cooperation, maybe especially as it has been pursued in the last 18 months with a lot of sort of high drama and fanfare, can to some extent divert us from the real problems. As Gary points out, I mean, largely this has been an exercise to try to influence exchange rates. I'm not sure what proportion of the change that we have seen in the value of the dollar can really be attributed to the diplomacy of the G5 or the G6. In fact, whether any of the proportion of that change can be attributed to the activity of this type of international cooperation. The dollar was well on its way down before the Plaza meeting in September of 85. It has been a question in the last 6 months of whether or not it could be stabilized. Certainly the Germans and the Japanese wanted that to happen. We were somewhat uncertain. We were fearful of a sliding dollar with no floor. On the other hand, we wanted to try to parlay any agreement to halt the slide of the dollar into some greater fiscal and monetary policy stimulus on the part of the Germans and the Japanese. I think I agree with Gary. I don't believe we got very much out of this agreement last month at the Louvre Palace in Paris. So in looked at in a somewhat longer-term perspective, we've bought some time, it seems to me, through this exchange rate policy. Clearly, it has served to diffuse, or at least to vent, protectionist pressures on the Hill for the last 18 months, but now we're about to run out of time. We don't have much more room to play, it seems to me, with respect to the exchange rate. And what we haven't done over the last 18 months, or 2 years, is to seriously address our continuing domestic imbalances. And it's in this sense that I believe this international cooperation may have been a diversion from the more serious problems, the more fundamental underlying problems, which is our budget deficit and our fiscal stalemate, as Gary points out, where we have very little prospect over the next couple of years of changing that. Whereas I think had we addressed that question vigorously, had the Treasury Department and the administration addressed that question vigorously in 1985 and not simply let it up to Congress and the Graham-Redmond process, I suspect we might be better off today. And I would have preferred to have seen that than the high drama of the Plaza and Louvre agreements.
Since we're running out of time, I would like to ask each of you at least one question regarding the trade policy, which is becoming such a hot topic. A consensus has emerged, it seems to me, that U.S. trade policy has to become more assertive. But assertiveness, as we all know, can easily lead to a fight. So what is, in your opinion, Gary, what are the proper limits of assertiveness in this context, beyond which the threat of a trade war becomes intolerable?
I think we have to go back to the old distinction between a world economy which is too buoyant and a world economy which is depressed. The analogy is the patient who has high blood pressure or the patient who has low blood pressure. You have very different remedies for these situations. Now, in a situation where the world economy is rather flat, a low blood pressure economy, we should redesign the system so that there is a much greater burden on countries with current account surpluses to stimulate their economies, to liberalize their trade, and to discharge those current account surpluses. And this brings me to the assertiveness of U.S. policy today. The problem with the way we're framing the policy initiatives is that we're doing it on a very bilateral basis and saying to Taiwan, open your markets because you have a surplus with us, to Japan the same, Korea the same. What we should do is recast that in a much broader way and say to countries with a global current account surplus today, you liberalize. Either you liberalize your trade policies or you stimulate your economies on a global basis, but not bilaterally with the United States. Now, if the temperature or if the pressure of the world economy changes dramatically so that we get into the high blood pressure situation, a inflationary situation, then of course we should come back to the old and familiar rules, which is that the deficit countries, the current account deficit countries, should restrain their economies. But that's not the problem today. That's the problem for 2 or 3 years from now.
Henry, do you see a real threat of protectionism and an ensuing global trade war in the kind of a trade legislation that is being fashioned right now?
Well, I think I'm very much in favor of more assertive U.S. trade policy. What worries me is that we have undertaken that approach in a situation in which our macroeconomic policies have basically not changed, and therefore these enormous pressures that I talked about earlier remain, it seems to me, in our trading sector. We have yet to see, of course, any benefits from the recent devaluation of the dollar. I think we will see some, but nevertheless there's enormous pressure in Congress, continuing pressure for protectionism. And when you pursue an assertive trade policy in a situation where your macroeconomic policies are inadequate or inappropriate, then you run the great risk that you're going to have to carry out your retaliatory threats, and that your assertiveness is going to contribute not to opening markets abroad, but to closing markets at home. And I think that's really where we are at this point in time in the United States this year. I would very much like to see us back off a little bit from the, as Gary says quite correctly, from the effort to try to resolve a whole series of bilateral trade problems, and rather to keep pressure on bilaterally, but for the purpose of trying to move countries into more active negotiating in the global trade round now, which has been initiated in Geneva, the so-called Uruguay round, because there's where we can work on the global balances and where we can put pressure on the surplus countries, that is the countries with global surpluses. We can put pressure on them to really put on the table many of the measures that we believe are impeding access to their economy. So I would very much like to see us become much more aggressive in linking our bilateral activism, so to speak, to the negotiations in Geneva, which, as most of you know, are not going very fast at this point.
Well, thank you. We are opening the floor to questions to the panelists and to myself in case anybody wants my answer. Yes, ma'am.
We're seeing on the nightly news a very sad commercial that's put on by the labor unions. It's showing an American worker sitting out in the cold with no place to go. Do you see in your anticipations of expanded exports or in devaluation of the dollar any hope for improving the labor situation so that we can get on with the other things that we've been talking about doing?
Perhaps you, Gary, can answer.
Well, I think there are two dimensions to this question. One, will we see, in a sense, an export-driven stimulation to our manufacturing sector? And I think clearly the answer is yes. I think it's just inevitable that at some point there's going to be a turnaround, and it has to be in manufacturing for reasons Henry said. It won't be in services. It won't be in agriculture for another cluster of reasons. So there will be a good stimulus there. But there's a second claim in these advertisements which will probably not be answered. We developed a situation over the last, since the end of the Second World War up to the early 1980s, where some sectors of the manufacturing economy paid much higher than average wages, twice in the case of automobiles and steel. And a major complaint is that the jobs available are not going to pay 2 times the average manufacturing wage. Indeed, they may only pay the average. Indeed, they may pay less than the average in some cases. What there has been is a huge harmonization of wages in the economy, and I don't see that being reversed. And so that part of their claim, namely getting back to, if you will, princes of labor, very well-paid blue-collar work, very regrettable, but I don't see it coming back.
Yes, sir.
As everybody knows, the balance of payments in any given period of time has to be zero if you take in all capital movements and all trade and all services. Therefore, we could not continue to have a trade deficit unless we had the capital inflow. Recent policy changes in the last few years have, if anything, tended to stimulate capital inflow, particularly the change in the taxation of interest paid to foreigners and so forth. Wouldn't one avenue of solution be to make it less attractive for foreigners to invest money in the United States and therefore have the effect of dropping the trade deficit?
Henry, do you want to address this question?
Seems to me we tried that policy once in the late 1960s when we turned to capital controls. In this case, that was the outflow of capital to try to reverse a declining trade surplus which we were facing at that time. I would say I would not be in favor of those sorts of measures. It seems to me we should welcome that foreign investment as long as the determination is made by foreigners that this is a better place to invest than either at home or in the developing world or in other places where they have alternative investment opportunities. What we need to worry about is how we use that foreign inflow of capital, as I suggested before. And my guess is that we are going to continue to receive rather generous and significant inflows of capital over the next 18 months, assuming that our growth rates are projected as they are currently, until such time really as the alternative opportunities for Japanese capital and for German capital, European capital, improve. That means until such time as their own domestic situations improve significantly to provide some alternative outlet. Up to this point, we are still the most attractive place for them to invest, and under those circumstances, I think we should welcome their investment, but then use it wisely. And I'm concerned that we may not be using it wisely, although I'm hopeful that this tax reform, the worst part of the short-term effects of the tax reform bill, which everyone assumed would be detrimental to investment, may be behind us now, and perhaps we'll get some pickup in investment this year.
Do you wish to add something to it, perhaps?
A little bit. I think that the suggestion implicit in Robert Salmon's question, namely that we should make investment in the United States a little bit less attractive, perhaps reinstating withholding tax or in some other way. That's a very interesting one, and I think we'll hear a great deal more of that in the months and years to come. Here's how I think the economics of that would play. In the short run, making investment in the United States less attractive will do nothing on the current account deficit, which really reflects our basic savings posture in the United States. So how will the adjustment come? Well, we make current returns to foreign investors less, and we'll get a shock in the exchange rate. That is, we will accelerate the process of exchange depreciation, and that will make assets cheap. Henry Now's bazaar for the world for buying cheap companies, cheap farmland, cheap office buildings, and so we'll continue to get the flow. But with the exchange rate down more rapidly than it otherwise would have been, that will provide a stimulation to this export boom, which I am anticipating. It's not in the charts yet by any means, and therefore we would get out of the downslide more quickly than otherwise. So at some point that may end up to be an attractive alternative. I think it changes the time profile a little bit, and it could change the time profile substantially. It won't work quite as the promoters would say it would work, but it's going to be a definite economic possibility, I think, political economic possibility in the next couple of years.
Yes, sir.
You addressed the impact of the declining American financial position and its effect on the U.S. strategic role, but can you also talk a little bit about what that decline will mean in terms of U.S. leverage in trade negotiations, especially multilateral negotiations? I understand that most of the successes in the multilateral negotiations have come when one country was a dominant force, and if the United States is no longer that dominant force, how do you see these multilateral negotiations playing out?
That's custom made for you.
Well, maybe we are seeing in the very, very slow pace at which this new eighth round of multilateral trade negotiations has proceeded, we may be seeing some of the consequences now of this progressive decline in American power. I tend not to draw that conclusion for a number of reasons. If you look at the size of the American economy, for example, as a share of the industrial world, as a share of the OECD's GNP over the last 15 years, and you average exchange rates over that period of time, you find that the size of the U.S. economy really hasn't diminished significantly since 1970. It's roughly about 41% of the overall GNP of the OECD countries. Now, it declined significantly in the 50s and 60s, but not roughly since the early 1970s. I think, of course, the role of the dollar is still an enormous influence and has enormous implications for the world economy. So I don't, and as I've suggested, I think in the manufacturing area and in terms of competitiveness, the picture is still somewhat mixed, but I think it's improving, and clearly our performance and productivity in the manufacturing sector has been really outstanding in the last 5 years. That 3.8% per year growth rate I mentioned is higher than the annual growth rate from 48 to 73. Which is looked back upon as sort of the halcyon years of the American manufacturing sector. So I think we still have considerable influence. I think the problem is that Europe is lagging much more behind in innovation and in structural adjustment and all of these things that have been going on in the world economy in the last 10 years than either the United States or Japan. And Europe has been a principal drag on this multilateral trade round, now for some good reasons, because agriculture has been one of the leading issues in this round and so on. But more generally, Europe has been a drag because it has lacked confidence in its ability to compete on world markets, and therefore has been much less eager to proceed with these trade negotiations than was true in the 60s, in the Kennedy round, in the 70s, and in the Tokyo round. The Japanese, of course, are only beginning to, I think, slowly realize the significance of the global trading system for their interests, and they came into the GATT much later. They're much less accustomed to the procedures of the GATT. Finally, we're dealing with a bunch of newly industrializing countries who are not used to dealing with the GATT, who are not familiar with the reciprocal trade negotiation process, who have a lot of psychological and political, I think, hang-ups, if I may call them that need to be overcome, and it's going to take a good deal more time probably to move this round forward. Hopefully the economic situation will remain at least tolerable, so that in fact in the next couple of years, probably not in any significant way until after the American elections, we will be able to move forward in this trade round. But I would not think that we, because of a decline in our power, that we are less capable of having a successful round this time around than in previous years.
Next question, please.
Would Professor Hufbauer please explain why an export boom is inevitable?
Well, it's inevitable if you believe that we cannot continue to acquire external claims against us at the rate that is portrayed in this chart, which is, I mean, the net external claims, as it goes down, they are getting larger and larger on this particular chart. The only way to stop that process is to export more or import less. And I believe the managers of the world economy are going to opt through a variety of policies for the export more solution. And if that's correct, that when I say managers, I mean Europe is going to accept our exports, Japan is going to accept our exports, and the third world is going to accept our exports. And then when it comes down to what exports, I think it turns, for various reasons, into the manufacturing sector. So that's my logic in saying it's inevitable. But I'm very careful in saying I don't know quite when this is going to happen. It will be a conjunction of when, in part, foreigners get tired of acquiring U.S. claims against the United States, U.S. bonds, stocks, etc., and we begin to save more, foreign economies are stronger, and therefore the result is an outrush of U.S. exports.
Yes, sir.
I'd like to come back to the question of U.S. leadership, and take specifically a column by Leonard Silk in the New York Times the other day. The general theme was that the lack of leadership in the world, among different countries, no leadership in taking policy actions that will avoid a recession. And one of the strongest positions along this line was by Henry Kaufman. And his general theme, as you may notice, was to the effect that we're locked in by our past policies, and that if we do have strong action to reduce the budget deficit and the trade deficit, we're likely to have a recession unless monetary policy is liberalized. But Kaufman says we're not likely to liberalize monetary policy because we're afraid of a free fall of the dollar, and it isn't clear that other countries are ready to liberalize their monetary policies. So that what's the risk then? That there's no leadership, effective leadership, in avoiding the actions that will get us into a recession, rather than a period where we have high exports and all kinds of good things going on.
So you were asking, in fact, what the risks of a recession are, given the passivity described in the column that you were referring
And
to?
the way the U.S., in terms of policy actions, is locked in, as Henry Kaufman says. That is, locked in the sense that if we do what many people say, sharply cut the budget deficit, sharply cut the trade deficit, if we do that, we're likely to have a recession unless monetary policy is liberalized, but there are concerns and anxiety about doing that. And he even quotes Heller of the Federal Reserve, that the main thing the Fed ought to do, he's the deputy chairman of the Federal Reserve, he quotes Heller to the, Leonard Silk quotes Heller to the effect that the main thing the Federal Reserve should do is to control prices.
Can I Can I have a stab at this?
By all means, everybody would be grateful.
You know, the duty of central bankers is always to talk against inflation. Regardless of what they're doing, they're going to say exactly what Bob Heller said and what Volcker has always said and so forth, that inflation is the number one enemy. Yet they do very different things, and we, of course, have seen Volcker doing something very different in the last couple of years. He's basically thrown away the whole monetary guidelines which he erected as a way of combating inflation in the early 80s. I think that when central bankers face this alternative of a recession in an economy which has a very creaky debt structure, as we know, globally and sectorally, and face that alternative, in a situation where inflation is pretty low and where you have excess capacity in many basic industries on a worldwide basis, they will continue to do what they've done right now, which is to liberalize the money supply. And I would say that we may come and see negative yen interest rates before this cycle is over. We did see negative Swiss franc interest rates in the 70s. Negative in the sense they imposed a tax on influx, so it was negative to foreigners trying to hold Swiss francs. And I could see that happening in the yen. But at any rate, they're very low now, and they can go further down, and I think the same with the mark. And that represents a use of monetary policy to combat the recessionary danger. So I'm relatively optimistic that they will say one thing and do another thing.
Here is leadership, see? Yes, sir. Oh, I'm
I
sorry.
think Henry Kaufman is due to have a correct forecast at last.